Hey everyone, and welcome to This Explainer. Today, we're totally demystifying Wall Street and breaking down the stock market so absolutely anyone can understand it. Whether you're completely new to finance or you're just looking to, sharpen up your knowledge a bit, we're going to make sense of all the noise together. Let's get into it.
So you might be looking at the news lately and thinking, is the stock market just a rigged casino for rich people? Honestly, it's a super relatable fear. But here is a shocking reality check. Keeping all of your hard-earned money just sitting in a basic savings account actually means it's secretly losing value every single day, all thanks to inflation.
But here's what most people really don't know. The market isn't some exclusive VIP club designed to keep you out. No, it's actually the single most effective way for everyday people to own a piece of the world's most powerful companies. It's how you let your money actually work for you. Okay, part one. What exactly is a stock? Before we get into any complex charts or numbers, we really need to strip it all back to the most basic question imaginable. Think of it like this. A stock or a share isn't just a blinking ticker symbol on a computer screen. It's a tiny piece of ownership in a real functioning business. When you buy a stock, you are literally buying a fraction of a living, breathing company that has real products, real employees, and real revenue. Imagine a business is like a giant pie. If that company is divided into shares and you buy one slice, well, you're officially a part owner. That means you get to share in the company's overall growth. And sometimes they even pay out a portion of their profits directly to you in cash. Those are called dividends. And remember, this isn't some trendy new internet fad, right? The stock market has been building wealth for centuries. It dates all the way back to 1602 when the Dutch East India Company held the world's very first initial public offering. By 1608, traders were already inventing complex moves like short selling, and by 1860, the Standard & Poor's Index was founded over in the US. All right, part two, decoding the US market. Let's bring things back to the modern day and look at the real-life American market that we hear about on the news pretty much every single night. You constantly hear news anchors talking about the Dow, the S&P 500, and the NASDAQ. Well, these are just market indices, which simply lump a bunch of stocks together to give you a quick temperature check of the whole economy. The Dow tracks 30 massive U.S. companies. The S&P 500 tracks 500 major companies for a much broader view. And the NASDAQ, that one is packed with your tech innovators. But what's really interesting here is that these abstract financial terms represent the familiar brands you use every single day. We're talking Apple, Amazon, Tesla. When you invest, you're literally investing in the very companies that make the phone in your pocket or deliver packages right to your front door. Part 3, how companies go public and prices move. Let's see how this all builds together. How do these household names actually get onto the stock exchange in the first place, and what makes their prices go up and down? It all happens through an IPO, or initial public offering. Basically, step 1, a private business decides it needs to raise some serious cash for expansion. Step 2, they hire investment banks to underwrite and organize the whole deal. Step 3, they hold the IPO, selling shares to the general public for the very first time. And finally, step 4, those shares trade freely on the open market. Now, why go through all this trouble? Just look at these historic numbers. Alibaba raised $25 billion. SoftBank raised $23.5 billion. Visa raised almost $18 billion. I mean, that is a massive injection of cash that the company never has to pay back like a traditional bank loan. It allows them to fund massive future growth. So once that stock is public, its price moves based on the absolute simplest economic rule on earth. It's just a real-time tug-of-war between supply and demand. If a company reports incredible profits, demand surges. More buyers jump in, and the price rises. But if bad news hits, supply increases because panicked investors sell, and that pushes the price down. Moving right along to part 4, debunking common investing myths. Now that we've got the mechanics down, it's time to enthusiastically destroy some of those common beginner myths that are totally holding you back from building wealth. Myth number 1, investing is exactly like gambling. Okay, yes, both involve risk, but the mechanics are fundamentally different. Gambling is a zero-sum game where the house always has the mathematical edge against you. The stock market, on the other hand, is backed by real businesses generating real revenue. And historically, it trends upward over time simply because economies grow and innovate. Myth number 2, you need thousands of dollars to even start. Honestly, that used to be true, but that world no longer exists. Today,
Literally anyone with a smartphone can start investing with just one single dollar thanks to fractional shares. You really don't need a massive bank account to buy a piece of a quality company anymore.
Oh, and beware of the cheap stock trap. Beginners very often think a $2 stock is this brilliant bargain compared to a $200 stock, but the price per share tells you absolutely nothing about the company's true value. A $200 stock with market dominance and strong earnings is a far, far better investment than a struggling $2 stock that's drowning in debt.
And that brings us to part 5, the ultimate investing insight. So how do you actually win at this? We've arrived at the climax of our explainer and the single most important takeaway you really need to remember.
A lot of people believe the secret to investing is perfectly timing the market. Buying at the absolute lowest bottom and selling at the highest peak. But even professional fund managers fail to do this consistently. In fact, studies show that missing just the 10 best trading days over a 20-year period can literally cut your total returns by more than half. Let that sink in.
Which brings us to the ultimate golden rule of investing. Time in the market beats timing the market. Trying to jump in and out is honestly a fool's errand. Consistency, patience, and just holding on to quality companies for years, that is the real secret to financial success. You don't need to stress out and check your portfolio every single day. Just let time do the heavy lifting for you. So I'm going to leave you with this final thought. Are you ready to take your first step into the market today and start owning a piece of the future? Your financial independence is waiting for you. If this explainer helped clear things up, please remember to hit that subscribe button and definitely click the link on screen for our next explainer to keep expanding your knowledge. Catch you in the next one.